Joining in on the show is Jinesh Gopani, Fund Manager, Axis Mutual Fund. Jinesh, good evening. Thank you so much for taking time out for us. First, let's talk about, the larger picture, what you're making of this rapid run that our markets have seen. Despite valuations, many would argue, being on the frothy side, there just seems to be, nothing that's stopping equity markets right now. How are you looking at valuations? And, should an investor really be looking at things in the traditional manner, or would you say we're seeing a structural shift perhaps taking place?
Yeah, sure. See, if you see the market and if you see the global world, liquidity is ample, and it is trying to find ideas where there is 15% growth, 20% ROE, and if you see last 3 to 4 months, you have seen a huge amount of flows coming into the emerging markets. And that is precisely for the returns what the investors want, maybe in excess of 5%, 10% or 15% depending on their risk appetite, and that is where the global money is flowing. And to that extent, it is chasing certain stories which I said are having a good growth opportunities and good ROEs, and that is why the valuation, if you take India, you have certain sectors where valuation have really gone up and continue to remain at that levels. So it is a pretty tricky situation, and it's making a bit uncomfortable in terms of what will happen in event of reversal of this money. But as of now, as things stands, the money flow remains strong. The QIBs are getting subscribed big time, IPOs are getting subscribed big time. So valuation to some extent has taken a back seat. So we need to be cautious overall. However, having said that, we need to be also playing this game as it is.
Jinesh, I'm tempted to ask you about the most recent issue right now in the market, which is the concerns being raised once again for the IT sector. Now TCS has come out and raised a red flag. Earlier it was pharma which got derated because of some of the regulatory issues from US FDA. What are your thoughts on these two sectors in particular? Are these a complete no-no for your fund, for the industry, or is there a structural model which is getting completely challenged for these two industries?
So IT, if you see, you have near-term challenges, but long-term growth potential still remains pretty strong. Also, if you see, the companies are loaded up with free cash flows and good amount of cash generation they have. So I don't think there is any reason to panic significantly if the view is 3 to 5 year. Anyways, near term looks bit uncomfortable for the companies, given the clients for whom they are working are itself under tremendous pressure on the cost side. So it's a near-term slow trajectory, but if you take 2-3 year view, I don't think there is any problem. So hopefully by December you will get to know how US will be shaping up, and then you will have the budgets coming into play by Jan, Feb and March. You will get a better picture of how the US companies will be doing their expansion plans. So we are not very worried on short-term blips on the sector, and they are very high quality sector, very good companies generating good cash flows. So that is there on the IT side. On the pharma side, it is very stock specific. One general observation is on the US FDA side, which I think it's a passing phase. You have to learn from mistakes and go along with that. But having said that, the opportunity for the companies in US is very large, and whosoever is able to play that story well in next 3 to 5 years should do very well once they have this resolution of US FDA, which has been almost in all the companies in some time or the other.
Jinesh, let's talk about the auto sector. It's the second largest sector in your own fund. You own very chunky stakes in some of the companies like Maruti. Overall, what are your thoughts on these names? Maruti, Tata Motors, all of them are hitting fresh lifetime highs. How have you been analyzing the sales numbers for last couple of months? Do you think the momentum will continue and they will back the valuations some of these stocks like iShares, etc., all of them are trading at? What are your thoughts here?
If you go back into the history, always auto sector is directly linked to the momentum in the GDP. And India being a domestic driven economy, it is more so with rising per capita income, more money in the hands of rural now after monsoon being good, and pay commission coming back. Auto sector should see significant amount of improvement in terms of volumes. So we have always played that as we want to play domestic story, so that remains a perfect GDP linked story to play. And we feel that as of now the growth rates should be in the region of 10 to 12%, but going forward, if all goes well, it can inch up to 15% at the exit rate of the at the year end.
Right. You manage something like 10,000 crore rupees, and I noticed that the bulk of those investments are in financials, which of course have really been at the top of this rally. How are you positioned towards PSUs and NBFCs right now? Do you expect, another sharp move upwards coming for these stocks?
We are on the bottom up side of the stock picking and has always been going that way. So wherever we feel the management is good, the opportunity on the sector is good, and there is a capability of the management to go to next level, we have been investing very aggressively on those side, and that is why private banks and NBFCs give us more comfort in terms of investments. However, having said that, we are careful of the fact that if the valuations are getting stretched on the NBFC side, so we need to be cautious on that front. But from the longer term trajectory point of view, if you ask me 3 to 5 years down the line whether this sector is still opportune in terms of giving you 20-25% CAGR, answer is yes. So as long as that GDP linked story continues, banks become the sort of an evergreen kind of a sector to play around, and especially private banks.
Okay. Jinesh, let's talk about market, earnings. Have you started pricing in meaningful corporate earnings revival, say, in the next 2 to 3 quarters? Because that's something that hasn't quite happened of late.
Yeah, so we are always 6 months ahead of the earnings season in terms of the price performance, and that is what is being seen now also, with the expectation of good monsoon, hopefully good Diwali, with this pay commission coming back in terms of the money flow to the certain sections of the population, then GST getting through. So all on the domestic side, all things looks positive on an incremental basis. So to that extent, I think the way the money flow is coming is also justifying that incrementally on the domestic side you are seeing significant improvement in terms of momentum on the GDP side, and that should eventually get translated into earnings, maybe not this quarter, maybe next quarter down the line. So incrementally, if you are seeing positives coming up, obviously market tends to be pretty fast in assuming those stories and the earnings, and that is why the valuations.
Jinesh, your own fund, which is a pretty large one now, over 10,000 crore assets under management, has done pretty okay. 15% on a 1 year basis, 30% plus on a 3 year basis. Looking at where we are in the earnings cycle or in the economic recovery cycle right now, what kind of potential does Indian market have in terms of returns? Do you think these kind of returns can be matched over the next 2, 3, 5 year kind of a horizon?
It's pretty tricky to answer that, but ideally we see at a nominal GDP plus 3 to 4% is what you should expect from the equity side of the market. So if nominal is at, let's say, around 11-12%, you should expect 15% kind of CAGR possible, especially if you take bottom up. If you are invested in a company which is delivering you 20-25% ROE on an average basis, you expect those kind of returns coming on the portfolio as such. So our focus is bottom up. We try to find ideas which are having a higher ROE kind of trajectory along with decent growth potential.
All right, Jinesh, we'll leave it at that. Thank you so much for taking time out for us, Jinesh.
Thank you.
Gopani.
Thank you very much. Pleasure is mine. Thanks.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.